Hi everyone, it's Peter Schiff. It's Friday, January 28th, 2011. Well, I'm recording this video blog from my new home studio where I record the Peter Schiff Show on schiffradio.com. If you're not listening, make a point of tuning in. I do the show 2 hours a day. It's live from 10 a.m. to noon Eastern Time, but you can listen to it at your leisure on schiffradio.com. I think the lighting is definitely better down here. I think the sound is better, so maybe I'll start doing the video blogs down here. I think maybe I might have to work on a new backdrop so it's a little bit more interesting than just walls with some soundproofing. But anyway, let's go into what's going on today. It was a very busy day in the markets. First of all, we had a big drop in the stock market. The Dow was off almost 167 points. The NASDAQ closed down almost 70 points. It's one of the biggest down days I've seen in the NASDAQ on some time. Gold went the other way. Gold finally had a rally. It was up about $24. Silver rose over $1 an ounce today. Commodities in general were strong, particularly oil. Oil was up close to $4 a barrel, about $3.70. It closed at $89.33. The dollar was mixed. You know, the dollar index was up today, but it was mainly euro weakness. The dollar was quite a bit lower against the Japanese yen. It was lower against the Swiss franc and a little bit softer against the Aussie and New Zealand dollar. So it was more euro weakness, which I think is why gold was strong today, because gold has, I think, been keying more off the euro weakness than dollar weakness recently. Now, also there were protests going on in Egypt, and some people are kind of blaming the market sell-off, the flight to quality, on worries concerning that. I think that's secondary. I think far more important are some of the earnings warnings that we got today. We got bad numbers out of Ford, out of Microsoft, Amazon was warning. And also on the economic data, you know, we got the first look at the fourth quarter GDP numbers, which came out today, and it was not nearly as good as the market had anticipated. GDP rose by 3.2% for the fourth quarter of 2010. And you know what really drove the GDP numbers was a big jump in consumer spending and final sales. Big increase there. And what I think is interesting, well, first of all, everybody knows I don't think consumer spending really is economic growth. I think it's the consequence of economic growth. But if you are borrowing the money and spending it, what you're doing is borrowing from the future, because you have to pay the money back with interest, which means you have less future consumption to finance your present consumption. But it didn't even make sense to me that consumer spending would jump that much, given all the unemployment out there, given the weak job prospects, given the fact that people no longer have all this home equity to extract, and given the fact that food is more expensive, oil is more expensive. I don't know where the consumer is getting all this money. And then when you look at the GDP numbers, and what really jumps out at you is the nominal GDP was 3.4. And when the government adjusted for inflation, it only went down to 3.2. So if you look at the numbers, the government is assuming right now that inflation in the United States is running at an annualized rate of 0.25%. That's it. I mean, does anybody believe that? I mean, in order to believe that the economy is growing at 3.2% a year, you have to also believe that inflation is only 0.25% per year. Now, that just doesn't meet the smell test. You know, it makes more sense that the reason Americans are spending more is because the things they're buying cost more. So in other words, this isn't real GDP growth, this is nominal, this is inflation, and the numbers that the government is using to adjust the GDP for inflation are bogus. The government is understating the true rate of inflation, and when they do that, they automatically overstate the rate of growth. Also, I think I wanted to mention the downgrade that the S&P had for Japanese government debt. This happened, I think, was it 2 days ago, and Japan's debt was downgraded to AA-, which is 4 notches below the U.S., and it's the same rating that the S&P has for China. Now, first of all, you know, maybe S&P should be downgrading Japan. But what makes no sense to me is that America should have a higher credit rating than Japan, because we're in way worse shape than Japan. In fact, we owe Japan $1 trillion. Japan is sitting on $1 trillion worth of U.S. treasuries. So Japan's not going to default on its debt until it's asked us for our $1 trillion back, right? They can't default until they cash in all their treasuries. And then if they're out of money, well, then maybe, of course, they could always print, but that's a different story. That's inflation. But it doesn't make sense for a country that owes Japan $1 trillion to have a higher credit rating than the creditor. And in fact, if you look at the other fundamentals of Japan, their large trade surplus, their current account surplus, their huge domestic savings rate, if Japan had to raise taxes to meet its obligations, it has a much wealthier citizenship to tax, and it has the foreign exchange earnings to tap into. The United States, our citizens are broke. We don't have the domestic savings. And of course, when you look at our debt to GDP, you just can't look at the official debt to the official GDP. You got to look at all the off-budget items, look at all the Fannie and Freddie debt. You also have to look at all the state debt, because the states and the federal government are taxing the same people. So you have all these claims on Americans. We are in far worse shape. But look at China. How can China have a lower credit rating than the United States? They got $3 trillion in foreign reserves. And the Chinese government barely has any debt. It's almost non-existent. So China has hardly any debt, and they got $3 trillion to pay it off. I mean, they got no problems paying their bills. We've got trillions and trillions of debt, and there's no way we can pay it back. Yet S&P is saying that we're more creditworthy than China. None of it makes any sense at all. And the yen actually rallied, I mentioned, quite a bit today. It initially sold off on the S&P downgrade, but it recovered everything it lost today. And so maybe people are realizing how insignificant the S&P ratings are. The whole thing is a joke. They missed the subprime completely, and they're obviously missing the biggest subprime borrower of them all, the United States government. Anyway, speaking about the U.S. government, I was noticing an article today on credit card interest rates, which apparently are now at a record high. I think it's about 15%. And, the reason that the credit card companies are now charging more in interest is because the government recently passed a law that limits the ability of credit card companies to raise rates on their existing customers. So the credit card companies know this. They know that if they start their rates out at a lower level, it's going to be more difficult to raise them later on. So what are they doing? They're starting out with higher rates right from the get-go. So here you have the government coming to the American public saying, we're going to help you out. We're going to pass these laws to stop these evil credit card companies from charging you high interest rates. And of course, it backfires. And now interest rates are higher because of the government law. I mean, that's generally how it works. And of course, part of the reason that credit card rates are high is because of all the defaults. I mean, credit card lending is very risky because you're lending money without real collateral. And a lot of people, I believe, and I've said this before, I think a lot of people are using their credit cards because they know they're not going to pay the money back. And that might be another explanation for the pickup in consumer spending that we noted earlier, other than inflation, is I think people are using their credit cards more freely because they owe so much money. They know they're going to ultimately default, or they're not going to pay, and they figure they might as well go out with a bang. Because if you're buying things with a credit card and your intention is not to pay your bills, then what, why not spend? I mean, it's not your money anymore. It's somebody else's money, so you might as well spend it. And of course, it's also possible that many people who are no longer making their mortgage payments have decided to spend some of that money, at retail sales, because they're not having to make any mortgage payments. But all of this is hurting the banks, because the banks now are losing money, and so our financial system is being compromised by the fact that money that should be going back to repay debt is instead en route to Walmart to buy more merchandise that was made in China. Anyway, that's it for today. Have a great weekend, everybody. I will be back next week with more video blogs and, of course, more of SchiffRadio.com. Again, do tune in. We got a lot of great information. I had Ron Paul, Congressman Ron Paul, was my guest on the show today. We get a lot of great guests coming on the Peter Schiff Show, and I'm taking your phone calls live for the 2 hours. So it's a great time to call in and ask me any questions. Anyway, take care. Bye-bye for now.